Markets and some AI stock picks. We want to bring in our next guest. We've got Tom Hayes, Chairman and Managing Member at Great Hill Capital, joining us. All right, Tom, thank you so much for joining us here at the Stock Exchange. It's always good to see you. Let's talk overall market. September hasn't been, it's a September to remember, but not for like it felt like everyone was coming into this month with a bearish kind of tone and expectation that, we were going to see a lot of bumps. Yeah. But so far, that really hasn't been the case.
So far, so good. I mean, even this week, you're supposed to sell Rosh Hashanah, buy Yom Kippur. S&P's down on average 0.5%. Not the case. I mean, even with Jay Powell out yesterday saying that the market's overvalued or warning about that, I think you got to really peel back the onion, because when you say the stock market is overvalued, you're basically saying the Mag 7 is overvalued because they're 40% of the weight of the S&P 500. Are small caps overvalued with 35% earnings growth next year, trading at 17 times earnings? I don't think so. Is energy overvalued, trading at 15.2 times earnings? Lowest weight in the S&P since the COVID lows. Huge buying opportunity in 2020, huge buying opportunity now. Power of the AI story, the covert AI play? The answer is no. They're going to have 17% earnings growth next year. So I think we need to be nuanced here. If you're just going to go out and buy the indices and buy the Mag 7 and chase the things that have worked in the rearview mirror, I think Jay Powell is right. If you're going to be nuanced and look at the catch-up trade and the laggards, I think there's an enormous amount of opportunity.
So where do you see opportunity?
Good question. Well, I think you got to pay attention to small caps, number one, for the reasons I said. Lowest multiple, highest earnings growth. You got to pay attention to earnings if you believe in the AI, energy, if you believe in the AI story. Again, second highest earnings growth next year in the S&P 500. And this weighting in the S&P right now, going back to 2020 levels, you remember when energy turned negative and they were paying you to take barrels of oil?
Yes.
We were pounding the table saying ExxonMobil at $33. Well, there are opportunities right now in the natural gas space. Data center demand is going to grow 165% by 2030, according to Goldman Sachs. 60% of that is going to be powered by natural gas.
A quick follow-up thought on small caps. There are many who's talking about and advocating for the breakout here that we've been seeing, honestly, recently. The challenge, though, is, when you look down the spectrum, I mean, some are just not profitable.
Correct.
So, so that's a challenge that you have to take into consideration, right?
Yeah. If you bifurcate between profitable and unprofitable, obviously the profitable have dramatically outperformed. But all the conditions are set for those periods like the early 2000s when small caps dramatically outperform. Those conditions being rates are coming down so these businesses can refinance debt. The problem with small caps is always solvency risk. You refinance the debt, you invest in property, plant, and equipment, and we're off to the races.
Okay, and we're off to the races. I want to go through a few names, or a couple names that are on your list, and plus we also have this news out on Alibaba. Let's start out with the Alibaba, with the news that they're planning to increase their AI spending, right? They'd already talked earlier in the year about spending what would amount to the equivalent of around $50 billion, right? And now they haven't named an actual number, but it's going to be north of that, right? And then their CEO, Eddie Wu, saying that the projection for global spending investment in the space will be $4 trillion over the next 5 years. What's your take on Alibaba now? Because, like you said about pounding the table, you pounded the table on that one before.
Listen, this was the hardest position of all time. Look, we started buying this over $100. It dropped to $60. We pounded the table, buy, while all the sell sides were saying China is uninvestable, and all we saw was $25 billion of free cash flow, $80 billion on the balance sheet, number one China middle-class e-commerce retailer, number one in cloud, and cheapest way to play AI in the world. We brought our basis down to $82. It's a $175 stock right now.
Yeah, it is.
It's going a lot higher. It's going a lot higher. This story hasn't even begun. They just launched Qwen 3.0 Max, which is the large language model with 1 trillion parameters. I'm telling you, Alibaba is the cheapest way to play AI in the entire world.
Okay, let me ask you this. So given where it is and where it will open today, do you expect it to double, and in what kind of time frame? Or are you, I mean, doubling might be a lot.
From yesterday's price, probably a double over
Potentially.
the next 3 years.
Okay.
From today's price, less than a double.
Okay.
Yeah.
Okay.
I mean, this thing has upside.
Okay. All right. Let's talk about a couple other names on your list. You're liking Intel.
Yeah.
Tell us about your views, your thesis there.
Yeah, here's another uninvestable stock that we were on, talking at $20, $19. No one wanted it. They said it was uninvestable. We said, listen, our downside's protected. If they liquidate the thing today, we get $22. And what if anything goes right? Well, guess what's gone right? U.S. has come in,
yes.
$9 billion backstop. You think President Trump is selling Boeing planes to all these countries around the world? Now that he owns $9 billion of stock, or we own $9 billion of stock, he's going to be selling Intel chips. So this $5 billion from NVIDIA, it starts with CPUs. It's going to lead to GPUs. Why? Not because NVIDIA is doing charity work, because NVIDIA is capped at Taiwan Semiconductor, $4 billion per quarter growth. They're not demand constrained, they're supply constrained. They need Intel to succeed. They need Intel's fabs to succeed with advanced chips so they can supply all the unlimited demand for this around the world. So Intel could be a multi-bagger from here, and no one's paying attention to it.
I wouldn't say no one's paying attention to it.
Well, now they are. It's up 50%.
Yeah, they are now, yes. Okay, but let me ask you about one that I think is potentially one that no one's paying attention to.
Yeah.
Comstock is on your list.
Yeah.
It is down more than 50% year to date, and on a year-over-year basis, it's still down. But
right,
so where does it? Why do you have conviction over this?
You're going to love this one. So
Okay,
we started buying it at $8 and $9. No one wanted it. Went up to 28. Genius. Now it's come down 50%. We
it's
still
like
own it.
$3 and change.
No, Comstock Resource, CRK.
CRK, sorry. I'm looking at the wrong ticker.
By the way, it's up on the year. So it's $17 a share, okay?
Thank you for the correction.
That's okay because there's two tickers. I understand. No, not a big deal. It's at $17 right now, which is trading about book value, which is PV10, proved reserves, $5.7 billion. The problem is they have 30 years worth of unproved reserves, which means this is going to be realized at about $45, $50 over the next 3 years.
Okay.
You've got AI demand, you've got 1.1 million acres in the Haynesville Shale in Louisiana and Texas, close to the export terminals, close to the liquefaction terminals. You're investing pari passu with Jerry Jones, who made all his money in oil and gas to buy the Dallas Cowboys. And he says his holdings in natural gas are worth more than the Dallas Cowboys. This thing's going to be a multi-bagger. Covert way to play the AI boom.
And again, I want to correct myself. Comstock is slightly higher year to date,
Thank you.
Up 3% and change. And a year over year, it's actually much higher, up more than 60%. So that's a correction. I had the wrong ticker there. All right, Tom, you have some thoughts on the consumer. I mean, listen, they're still the backbone of the economy.
Yeah.
Overall, the consumer is still holding up, but the job market is bumpy.
Yeah, it's interesting. I mean, if you look at retail sales, they're pretty good. If you look at consumer sentiment, we're at lows not seen since the COVID lows, not seen since the European debt crisis in 2011, not seen since the great financial crisis in 2008. So what happens after consumer sentiment gets this washed out? Well, on average, 12 months later, the S&P is up 24.1%. Makes no sense. How can the market go up if the consumer is so pessimistic? Because it can't get any worse. The worst is priced in. So here's what's going to happen. Rates are coming down. People have $35 trillion of equity trapped in their houses. They couldn't get out from HELOCs because Chairman Powell held rates artificially high, too restrictive for too long. That's changing. They're going to start to pull that out. That's going to go into the economy. Companies are going to refinance and hire. Consumers are going to take equity out and put it in the economy. They're going to refinance and get money back. They're going to be able to move for the first time and have job mobility because they're not stuck in by such a low rate. And housing is 16% of GDP. So housing has been frozen for 2 years. The game is going to be back on. A lot of good things happening in the economy. So on the basis of what earnings look like now, Jay Powell is correct about the S&P 500. It's fully valued at 22.5. On the basis of what's going to take place as rates come down and all these other industries start to participate besides 7 stocks, early days.
All right. We'll leave our conversation there. Great conversation as usual. That's Tom Hayes, Chairman and a Managing Member of Great Hill Capital.